In this session, let's talk about preference share capital. Preference share capital is a special kind of share because the owners of preference shares, they are going to enjoy certain special privileges. The privilege can be number one with regard to dividend, and the second privilege can be with regard to repayment. So what is with regard to dividend? See, they get more or less a fixed percentage of dividend. So what dividend will be paid, that will be mentioned upfront. Number two, they'll get dividend right over and above equity shareholders. It means if there are profits, then dividend out of that profit should be first paid to these preference shareholders. And only after that, if any profits are left over, that can be used for paying to equity shareholders. Similarly, if the business is being wound up, then all the assets will be sold, the proceeds will be collected, that will be used for settling the outside creditors. After settling them, if anything is left over, first payment will go towards this preference shareholder, and anything left over only will go to equity shareholders. Okay, so we say these are all special kind of shares. They are going to enjoy priority. The priority is with regard to fixed amount of dividend and also with regard to repayment of capital when the business is being wound up. Let's look into the characteristics of preference share capital. Number one, preference shares can also be raised by public issue of shares. So it is not necessary that it should come only from the promoters. The company can also go for a public issue. It can accept money in the form of preference shares from general public as well. And if you look at the nature of these shares, they'll be generally cumulative. Cumulative means what? Let's say in a year, a company is supposed to pay dividend. Rate is already prescribed. Let's say 10%. They are supposed to pay 10% dividend. And if that company is not in a position to pay in that year because of loss, then whatever that dividend, that amount will be accumulated. So we say cumulative. In the next year, if the company is making profit and if it is in a position to pay dividend, then first this accumulated preference dividend have to be settled off. Only then the next year dividend question will arise. Okay, so that's why we say they are normally cumulative. So if any dividend is payable in the year of loss, that will be carried over to the next year or till when there is profit, then this cumulative dividends will be paid. It means they are not losing the dividend because the business is suffering loss. But that is not the case with equity shareholders. If the business makes loss, they can't even think of dividend. Okay. Then if you look at the rate of these preference dividend, they'll be generally higher. It will be higher than the interest on debentures, bank loans and all. Okay. And these preference shares, they will come with the condition that they have to be redeemed. It means they have to be repaid at the end of the stipulated period. Whatever the period mentioned in the preference share certificate, okay, that time it has to be repaid back. We call it as redemption of preference shares. And these preference shares, they basically are hybrid form of financing because to a certain extent they look like equity because it fetches a dividend, right? But to a certain extent it also looks like debt capital because there is a fixed dividend. It fetches dividend, so it looks like equity, but on the other side that dividend is fixed in nature, so it also looks like debt capital. Then there is also something known as cumulative convertible preference shares. These shares are called as cumulative. They are also called as convertible. So cumulative means whatever the dividend that is accumulated, okay, up to a specified limit, that will be accumulated. This will be for a specified period, and after that period those shares will be converted into equity shares. So look at here, they are basically preference shares, and here cumulative dividend up to a specified limit for a period will be converted into equity shares. And here I said this preference shares have to be redeemed or repaid at the end of the stipulated period. Here companies can also redeem them at pre-decided future date. or they can also redeem them at an earlier stage if the company has more profits. So these are all the characteristics of preference share capital. And if you look at the types of preference share, there are various types. We have cumulative preference shares where arrear dividend will be accumulated. Non-cumulative preference share, there is no question of accumulating the arrears in dividend, meaning in cumulative, in a particular year, let's say year 1, business makes loss. So whatever is the dividend that will be accumulated, and in the second year if they make profit, so this accumulated dividend have to be cleared first. Then comes the second year dividend. Whereas if it is non-cumulative, in the first year if there is a loss, then there is no dividend. In second year if there is a profit, then only dividend for that particular year can be given. Then we have redeemable preference shares. It means these shares have to be redeemed and amount have to be paid back. Then there is also participating preference shares. It means they can participate in the surplus which are remaining after paying the equity shareholders. Then there is also non-participating preference shares. It means they cannot participate in the surplus which are available after paying the fixed rate of dividend. And there is also convertible preference shares. Here the preference shares can be converted into equity shares at the option of preference shareholders. So these are all the various types of preference shares. Then let us also look into the advantages and disadvantages of preference shares. Advantages, number 1, disadvantages from the point of view of the company. Number 1, it is voting right. Actually, preference shareholders, they do not have voting right. So since they do not have voting right, there is no risk of takeover. Of course, there are certain circumstances where they will get voting right. Let's say when there is a dividend payment in arrears. So that's an exception. Otherwise, they do not have voting rights. This is advantage for the company. The second advantage is with regard to dividend payout. Whatever the dividends that are required for preference shares, they are fixed. They are pre-decided. So what does that mean? It means preference shareholders cannot claim a share in the surplus profits unless and until it is a participating preference shares. Okay. So normally preference shares, dividend, everything is prefixed. They cannot participate in the surplus profits, but the exception is participating preference shares. The third advantage is it gives a leverage benefit. Why? Because the cost related to the preference share is fixed in nature. They are going to pay only the fixed dividend. So there is only a fixed cost. So using the fixed cost, if you could make the maximum utilization of that fund and maximize the revenue, then you will pay only the fixed cost. So there is going to be a significant, or if you look at the profit proportion, it will be much higher. I mean, the magnitude will be much higher, and that gives the advantage of leverage. And the next advantage is preference shares can be redeemed after a specified period. In India, we cannot have a irredeemable preference shares, so it has to be redeemed. Okay, and because of introduction of preference shares, there will not be any dilution in EPS, because the EPS is calculated based on number of equity shares. Here preference shares, they do not come into that ambit. So these are all the advantages. And if you look at the disadvantages, number 1, yes, they are pretty costly. Why? Because the dividend what you pay for preference shareholders is first of all not considered as a taxable expense. It means it is a distribution of profit. So you cannot claim this dividend as an expense. Since you cannot claim this as an expense, what will happen? Your profit will be more and you will pay more taxes. Okay, so look at here, it is costlier because they are not tax deductible. So it is not going to give any tax shield to the company, and as a result, it's going to be much costlier when compared with debt. Let me just give an example. Let's say you are paying 100 crore as interest. If you are paying 100 crore as interest, you will get a tax benefit. Let's say the tax rate is 30%. So this 100 crore will help you to save 30% on tax. So 100 crore into 30%, 30 crore you will be able to save on tax. So even though you are paying 100 crore on one side, on the other side you are saving 30 crore. So your net interest cost is going to be only 70 crore. But if you are going to pay same 100 crore as preference dividend, then on which there is no tax benefit. Okay, so on this 100 crore, actually you have to pay something known as dividend distribution tax. Okay, so on preference shares you will pay preference dividend distribution tax. So that is going to be an additional tax. Interest is giving you tax savings, but here you will rather paying additional tax. Okay, so that's the difference. Then the next disadvantage is preference dividends are cumulative in nature. Generally they'll be cumulative in nature. It means in 1 year, if the company is not in a position to pay dividend, then that will be accumulated and that got to be paid in the next year. But that kind of burden is not there in case of equity shares. Quickly, let's look at the difference between equity shares and preference shares. The first difference is with regard to dividend payment. Equity shareholders, they'll be paid dividend, if at all anything is available, only after paying preference shareholders. First of all, there is no obligation for the company to pay dividend to equity shareholders. If at all they are going to pay, they'll pay it only after paying preference shareholders. Okay, so that's the difference. If you look at from preference share point of view, they will get preference for dividend ahead of equity shareholders. The second difference is with regard to rate of dividend. For equity shareholders, the rate of dividend will fluctuate. It will vary year to year. But for preference shareholder, it will be fixed. It will be predefined already. Okay. And if you look at from convertibility option, there is no question of converting the equity share into debt or preference share. But preference shares, they can be converted into equity share. And voting rights, if you look at equity shareholders, they enjoy full voting rights, but preference shareholders, they have very limited voting rights.